Okay, and we're back. So, first, we'll talk about financial exchanges.
Oh, hey. I was just trying to scrounge up a little bit of extra money, so I decided to gather all the things around the house that I don't really use anymore. I'm just having a hard time trying to figure out what counts as money, and what I'm gonna need to sell to make money. Yeah, I don't think I'm paying off my student loans with this guy. In this lesson, we're going to discover all the different things people have used as money in the past, learn about the different ways we exchange money in the present, and ponder about how the very nature of money might change in the future. Money isn't just one thing. It's anything that represents purchasing power. This is why when we discuss forms of money, what we're actually talking about is forms of financial exchange, meaning the ways that purchasing power, or money, can be transferred from one owner to another.
Welcome to Adaptive Mind.
That's not going to help
Welcome to
anybody.
Miacademy.
1 second, we'll get rid of that.
Before the digital age brought computers and electronic payment, all forms of financial exchange were physical. Most ancient civilizations and tribes had at least one item that they found highly valuable. Pieces of metal, scraps of leather, shells, or crops like wheat or corn. These are what is known as commodity money because their value is in being a commodity or a good that can be exchanged for others. Metal and leather were valuable because they could be used to make things. Shells could be used to make jewelry, and wheat and corn were valuable because, well, who doesn't need food? Later on, some civilizations began using representative money, money that isn't a commodity itself, but represents ownership of the commodity and can be traded for it at any time. At one point, all money in the United States represented real-life gold. That $100 bill in your pocket meant the government was holding on to $100 worth of gold for you, and you can trade it in or give it to somebody else if you wanted. This was known as the gold standard, and it ended in the 1970s. But wait, if money today doesn't represent gold, what does it represent?
Yeah.
That's the thing. It no longer represents any physical commodity. Our money today is known as fiat money, meaning the only thing it represents is a promise. A promise by the government that it legally has to be accepted as payment. The most obvious example of financial exchange and the strongest example of fiat money is cash, physical bills and coins. Say you give someone a $10 bill, a $2 bill, and a quarter. That means you just lost $12.25 worth of purchasing power, and the other person just gained that much. A very interesting fact about cash is that governments are very keen on making sure that the materials used to make money are worth less than the value of the money themselves. For instance, if I could melt down a quarter and get $1's worth of metal, then a quarter and $1 would be worth the same thing, right? As a matter of fact, the US government had to change the way they made pennies in 1982 because the raw copper they used to make them were worth more than the pennies themselves. Don't go melting down your pre-82 pennies, though. It is very illegal to destroy still circulating money. If pennies ever leave circulation, though, go for it. Make a nickel off of that old penny. Most of the financial exchanges we do today, though, are not physical. Most of our money is in digital bank accounts. They're interesting because they kind of blur the line between representative money and fiat money. Think of it this way. If the number that you see on your bank account balance represents an actual amount of physical cash in a bank vault somewhere, but that bank vault cash Is your bank account balance representative or fiat? Some people have decided that digital bank account balances and electronic transfers should be considered an entirely new category of money: electronic money. There are tons of ways we can move money from our own bank account to somebody else's bank account. One way we do this is with paper checks. Checks order banks to transfer a specific amount of money from one person's account into someone else's. The recipient presents the check to their bank, and these numbers here tell the bank what account to pull the money out of. Debit cards are basically the same thing, which is why they're sometimes called check cards. These numbers here identify your bank account, and when you swipe your debit card at a store or input the numbers when shopping online, it authorizes the store's bank to automatically pull money from your account into theirs. With credit cards, you pay using the issuer's money, which you are then responsible for paying back to them later. Using a credit card is just like taking out a small loan, and if you don't pay the money back, you might not be able to take out big loans when you need them. We'll talk more about credit cards and loans later on in the course. People often confuse debit cards and credit cards, but they're two very different things. Debit cards transfer your money right then. Credit cards transfer the issuer's money, and then you have to pay it back later. These are the most common forms of financial exchange, especially in day-to-day life. But there are others that you'll occasionally see. With auto drafts or ACH payments, you provide your bank account details to a person or company, and they automatically pull money out at scheduled times. This is useful for things like monthly subscriptions. The opposite of this is direct deposit, where you provide your bank account details to a person or company, and they automatically put money in at scheduled times. This is how many employers pay their employees on payday. You might have heard of wire transfers in spy movies, but they're not quite so exciting in real life. A wire transfer is simply a speedier way to move money between banks, and unlike many other forms of financial exchange, wire transfers can be done internationally. Wire transfers can also be used for much larger amounts of money than other forms. All great reasons for an international spy to request wire transfers, but for most of us, it's just a good way to pay a lot of money at once, like for a house or a new car. With the majority of financial exchanges today being virtual, it's hard to imagine what money might evolve into further into the future. Some people say that the future of money is in cryptocurrency, like Bitcoin. This would be unlike anything we've ever seen before, because cryptocurrency isn't backed by anything, not even a government's promise. It instead gets its value from how useful it is. And with more and more high-profile companies like Microsoft, Starbucks, and AT&T accepting Bitcoin, its usefulness seems to be rising quickly. Now, I mentioned bank accounts a lot in this video, but did you know that banks are far from the only businesses who are solely focused on money? In the next lesson, we're going to be learning about all the different kinds of financial institutions that make your wallet their business. See you then.
Any questions about that before we talk about these financial institutions? All right, let's have a look then at financial institutions.
You can turn something like this into this in just seconds, because your niche or audience may like that slow.
But not without money, you can't.
I have too much money. What am I saying? No, I don't. There's no such thing. I have too much cash. I mean, like, this is ridiculous. I don't know why I thought I could just keep hiding it under my bed. But, like, where else am I going to put it? In this lesson, we'll be learning all about financial institutions. We'll start with the different types of services financial institutions offer, and then we'll learn about the different institutions that offer these services. Let's get into it. institutions in modern society. A financial institution is a company whose business is focused on saving, lending, exchanging, investing, and insuring their customers' money. It's kind of weird if you think about it. They make their money by playing with your money. In order to understand the difference between the different kinds of financial institutions, we have to understand the different services they provide. The most common services financial institutions offer people are savings accounts and checking accounts. Savings and checking accounts are very similar, so it's no big surprise that a lot of people don't quite understand the difference. With a savings account, you give your money to the institution and tell them, use this money as you wish. I'll want it back at some point, just not right now. The institution rewards your long-term contribution by putting a little extra money into your account, called interest. When you eventually take your money back, there will be more there than what you put in. We'll learn more about how interest works in the next lesson. A checking account, however, tells the institution, don't go loaning too much of this out. I'll be needing it back soon. This is the account people use to pay bills, go shopping, and pay their Mia Prep subscription with. So they need that money from the checking account at a moment's notice. Most institutions offer very little or even no interest on checking accounts because you're not giving them your money long enough for them to actually use it for anything. One of the things financial institutions use deposited funds for is to provide loans for things like vehicles or homes. But don't worry, they make sure to keep enough cash on hand in case anybody needs to make a withdrawal. Then, the borrowers pay back the loan with interest, meaning the financial institution gets your money back plus a little extra profit for themselves. We'll discuss loans more in depth in a later unit. Sometimes you have enough money for that big purchase in your account. You just have to use a cashier's check to pay it. When you ask the financial institution for a cashier's check, they take money out of your checking account and then provide you with an official check for that amount, which you can take to the car dealership or real estate agent as payment. Since the check comes from a verified financial institution, they don't have to worry about the check bouncing. So your payment is considered good, and you can complete your purchase right then and there. Cashier's checks are a safer and more reliable way of accepting large amounts of cash. The final major service financial institutions provide is help with investments. Savings accounts are great, but investing can net you way more interest. The downside is that they're also riskier. If the investment goes bad, you might end up losing money instead of gaining it. Luckily, we'll learn about different ways to minimize investment risks later on in this course. These are the bulk of the services that financial institutions will provide for you. The big question is, which financial institution does what? Banks are all over the place. You can usually find multiple in just about every town. While they're most commonly used to open savings and checking accounts, banks also offer the widest variety of services, including different types of loans, ways to access your money, and more. The downside to being everywhere and having all these options, banks are there to make money. For them, not for you. Savings and checking accounts at banks give you very small amounts of interest, while loans from banks charge you a lot of interest. Banks also have higher fees for their services, such as charging you $20 to $30 for a cashier's check. They're a for-profit business, so they have to find ways to bring in more money than they give away. Credit unions are similar to banks, with one very important difference. They aren't looking to make a profit. They still offer most of the same services, but they're willing to give their customers more interest than banks while charging them less. Wait, if credit unions are like banks, just better, why do we still have banks? Well, the thing is, because credit unions are owned by the members, there have to be strict criteria for who gets to be a member. It may be open to people who live in a certain town, or have a certain job, or go to a certain school. But if you don't fall into to that specific category, you don't qualify for membership. So you're stuck using the bank.
Trading fuels greatness. Business performance, revenue, your clients,
Learning about finances also fuels greatness.
Savings and loan associations, or thrifts, also offer deposit services like savings accounts, typically with better interest rates than banks. However, unlike banks, savings and loan associations have to do at least 65% of their business in home loans and related assets. Because they're required to do most of their business with consumers rather than large corporations, savings and loan associations have had a hard time keeping up with banks, and very few still exist today. Depositing your money into a checking or savings account at a bank, a credit union, or a savings and loan association is completely safe. You do not have to worry about losing your money. Bank deposits and thrift deposits are insured through the Federal Deposit Insurance Corporation, or FDIC for short, up to $250,000. So even if the bank fails or goes bankrupt, you're still guaranteed your money. Similarly, credit unions are insured by the National Credit Union Administration, the NCUA, for up to $250,000. If you're looking for somewhere to deposit your money into a checking or savings account, always double check that it's insured by the FDIC or the NCUA. Not all financial institutions are safe places to store your money, though. Brokerage firms deal exclusively in investment options, which are risky. Remember, with investments, you might gain or lose a bunch of money. Brokerage firms.
So I'm gonna stop there for a second, just for the kids who might be listening. That would be things like Fidelity or other types of places where you can kind of get on the stock exchange and trade stocks back and forth, or bonds and mutual funds.
Firms don't offer typical banking services like savings accounts or loans, but they're the financial institution people use when they've got extra money that they'd like to try to grow quickly. Another type of financial institution that operate vastly differently from banks are insurance companies. Insurance companies collect small amounts of money from a bunch of people called policyholders. Then, when one of those policyholders experiences something that puts their finances in danger, the insurance company gives them a big chunk out of the pot. We'll learn more about insurance later on in the course. There are a lot of financial institutions out there in the world, but these are the ones that you'll mainly be dealing with throughout your life. Several of them use interest, either to help you make a little more money or to make more money from you off of your debts. In the next lesson, I'm going to teach you how interest works, as well as some warning signs to look out for when you're trying to pick which financial institution to do business with. See you then.
Any questions about financial institutions? All right, let me pause
Which
it.
one do you use?
I use
Your piggy bank?
I don't have one.
You don't have a piggy
I
bank?
just use a box.
Bank of Dad.
Under your bed.